Okay, everybody, it's me, Gregory Mannarino. Do you know what today is? Well, I'm going to tell you. It's the first, day of the new year that I am doing a video blog. This is my newest segment of Markets Look Ahead. It is Sunday, January 2nd, 2022. I have a lot to cover with you. I'm going to talk about my top 5 trends for this year. Now, I hope you had a chance to watch my final video of 2021 on Friday, where I did cover a whole bunch of stuff, predictions for this year, what I expect to see. And I must say, it's going to be very interesting to look back on, Friday's video and this particular video next year to see what actually happened. Did what Greg Mannarino say here, did it happen? Did it not happen? Did he get it right? Did he get it wrong? I don't know. I guess time will tell. All right, people, look. So what we're going to do with this segment of Markets to Look Ahead is what we always do. We're going to look back first, just a little bit. All right, just a little bit. So how did we end last year? Well, global stock markets ended either at new or record highs or very close to them. No surprise to any of you who follow this blog. I have been a major bull with regard to this market for a very long time. And as you all know, those of you who follow this blog at least, I will remain that way until something changes. The dynamics that we follow all the time with regard to this market, if they remain the way they are, I will not change my stance. But even if they do remain the way they are, we should expect certain things to happen with regard to this market, cryptocurrencies, gold, silver, crude oil, all kinds of stuff. And again, we're going to cover that here. But like I said, so we ended last year pretty much on a high note globally with regard to the stock markets, regardless of the fact that the global economy continues to free fall, shrink at its fastest pace in history ever as a percentage of GDP. You're not allowed to know these things. And I expect, and I'm sure you do too, that if the bad economic news keeps coming, and it will, you can expect the market to more than likely go higher. In fact, I'm going to go out on a limb here and say, yes, this market is going to go higher this year. We will end the year higher. We will end 2022 higher. I believe that, but we're going to experience some volatility, and we're going to talk about that. So let's just jump right into it here. So I'm going to cover my top 5 trends for this year here. Number one, despite the fact that we continue to hear about tapering from the Fed, meaningful rate hikes from the Fed, what I will tell you is my number one trend here for 2022 is, more easy money, looser for longer. The Federal Reserve, as you all know, has zero intention of stopping what they have already started, and that is to become the lender and buyer of last resort, to buy it all. This theme is going to pervade central banks around the world who are going to continue to do that. Now, with that said, we can expect other things to develop, and we're going to talk more about that moving forward throughout this video blog. So I'm just going to sketch out my 5 top trends. Number one, like I said, more easy money, more loose monetary policy from the Fed, more rate suppression, negative rates, way negative rates in real terms. Hold that thought too. We're going to cover that in more depth in just a little bit. So that's number one for this year. And understanding, let me ask you, those of you that have been with me for any length of time, like I said, if you've been with me for 6 months, that's it. You already have a very good perspective on the market. If you've been with me for years, I don't think anybody knows the market better than you do. That's the truth. All right, so that's number one. Number two, in real terms, Not relative terms, people, because everyone screws this up. I don't understand why. In real terms, in absolute terms, the dollar will continue to fall. The US dollar value or purchasing power will continue to fall, more than likely fall faster moving forward. So what does that mean? What does that mean with regard to inflation? You can expect inflation to surge. As a matter of fact, food and energy prices are going to continue to skyrocket along with debts and deficits. So that's number two. That leads us right to number three, and I have it right here. I was writing this morning. Going back to food and energy, that's another big trend we're going to see this year. Much higher food and energy prices, playing right into the weakness of the dollar in absolute terms. Relative terms, and I've covered this a million times, I fully expect the relative strength of the dollar to remain high. I'm talking about value of the dollar relative to other currencies. Again, I continue to cover this, but people don't understand what I'm talking about. You can look at the dollar in essentially two ways. Its absolute strength based on its purchasing power, or its relative strength if you weigh it against other currencies. You understand? So its absolute strength will fall. Inflation is going to continue to skyrocket. We haven't seen anything yet. You know that if you've been with me for any length of time. But in relative terms, the dollar will remain the prettiest belle at the ball. Period. That should be pretty straightforward for you here. Number four, and this plays right into number one, you can expect more price action distortions to occur across the spectrum of asset classes. Okay, what is Gregory Mannarino talking about? I believe, and again, I'm sure you do as well, if the Fed is going to keep pouring easy money into this market, artificially suppressing rates for as far as the eyeballs can see, and they're going to talk out of the other side of their mouth about tapering, which they're not tapering anything. They're going to talk about raising rates. There'll be nothing meaningful moving forward. I mean, if they're going to raise rates, we're talking about a fraction of a percentage point, which will not do a damn thing to stop surging inflation. And that's the falsehood, I think, that has been playing out via the mainstream narrative. It's, oh yeah, the Fed's going to raise rate to combat inflation. It's a joke. It can't happen. It won't happen. And the Fed has no intention of making that happen, okay, because it would melt down the stock market. And that's not their goal. The Federal Reserve is determined to continue to inflate the debt bubble and inflate the stock market. So you can expect price action distortions to get much, much worse. You can throw things out the window like PE ratios, forward guidance, and all that stuff that used to matter in the old days don't matter anymore. It's all about easy money. And it's going to be more about rates being more negative in real terms. We're going to talk about that a little bit more here. So understanding, again, number one, that the Fed is going to keep easy money going for as far as the eyeballs can see and then some. So loose, easy money policy is going to propel the stock market higher. What does it mean for other assets? Should you be abandoning becoming your own central bank or betting against the debt? Absolutely not. You should be more, vigilant in acquiring anti-debt units of physical gold, physical silver, cryptocurrencies as well. Moving forward, there's just no doubt about it. Bet against the debt, become your own central bank. I should have thrown that in there as number one. All right, anyway, so number four, more price action distortions across the spectrum of asset classes. And I would also expect things like gold and silver to remain massively undervalued as JP Morgan, the super bank that continues to rig the market. They're going to continue to do that. And yes, they're going to probably pay millions of dollars and tens of millions of dollars in fines this year. But, it's all baked in, and you all know that. With regard to the market, people, let me say this. I do expect the market to continue its trajectory higher as long as the dynamics stay the same. What am I talking about here? Looking at the slope of the yield curve, the 10-year yield, the relative strength of the dollar. We're not looking at absolute terms here when we're trying to look at the drivers here of the market. So relative strength of the dollar. Crude oil. Well, I already told you I expect food and energy prices to increase moving forward, and so you can expect crude oil to go a lot higher. And of course, the MMRI, the Mannarino Market Risk Indicator, link in the description of this video. These are the drivers, these are the dynamics that we are going to be watching moving forward. But again, I believe we're going to see increased volatility in this stock market this year. Probably larger swings to the upside and larger swings to the downside. Personally, people, I would really like to see this market correct a little bit. We don't get corrections anymore. I mean, at a 5% drop in the S&P 500, people start freaking out. No, 5% is something that should happen on a regular basis. Doesn't happen anymore. Even 10%, even 15%, even 20%. These are normal fluctuations in a normal market. We do not have a normal market. We have a market that's being driven by easy money, which is not going to stop. That's my number one trend for the year, as I said. Number five, people, expect more control mechanisms to be put in place, more fear. Another reason why I'm talking about volatility. I expect to see the propaganda ministry continue to push some type of fear narrative on everybody. Okay. I also expect there to be more variants that are going to be completely unexpected. That's what they're going to tell you. Just like, Omicron, moronic. Oh, this one was unexpected. No. You and I knew it was coming, and you and I realized that more variants are coming, more methods of control, and more fear are coming. So, with that said, people, those are my top 5 trends, and I have a lot more I want to talk with you about, so stick around here. So let's just recap real quick. Number 1, more easy money. Duh. Number 2, a weaker dollar in absolute terms. Number 3, higher food and energy prices. And I'm talking higher, big time. Number 4, more price action distortions across the spectrum of asset classes, more volatility in the stock market. And number 5, more control and more fear. Okay, I already alluded to this, but I want to recover or readdress this here. I want you to think about what I'm going to tell you. I don't believe that many of you, even those of you who follow this blog, have thought about what I'm going to tell you here, really thought about it. So let's think about it. Right now we have a U.S. 30-year treasury, a government treasury bond here, with a yield of 1.9%. Okay, keep that number in your head. Meanwhile, the inflation rate here in the United States is like 6.8%, 6.6%. What does that mean? Think about what I'm talking about. So in real terms, rates are extremely negative. We have a negative rate environment on an epic scale. That mechanism will remain in place and probably get worse moving forward, and that is massively stock market positive. Why do you think, for example, you got the Federal Reserve in here and central banks around the world artificially suppressing rates? Well, it's to drive, again, it's to inflate a massive debt bubble. And we've never seen anything like this in the history of the world. It's a monster. It's a Frankenstein. You all know that. And also to inflate a stock market bubble and rob the middle class blind. So in real terms, we have a massively negative rate environment, and that is going to continue into 2022. And understanding that should make it clear to you where asset prices are going to go unless something changes. Look, something has to come out of left field, and I mean out of left field big time, for it to affect this market. Nothing that they've thrown at this market yet has gotten in its way. Not even a complete global shutdown of the economy. Nothing. Okay, an economic free fall don't matter. As a matter of fact, the faster the economy free falls, as a percentage of GDP, as you know, that's exactly what's going on. The higher the stock market's going to go. The higher the stock market's going to go in an environment of extreme negative rates. And that's exactly what we have right here in the United States. It's grand theft. It's theft on an insane scale where people who depend on an interest earning account for some kind of gains in their portfolio, they're losing money. Every day you or me or anyone has their cash in an interest earning account, even a high yield account in the United States and most places around the world, you are losing purchasing power. You are getting poorer every day of your life. That's why I've been explaining to you, be in this market, stay on the right side of it, large cap, dividend paying stocks here. And then for the longer run, betting against the debt, becoming your own central bank, holding physical gold, physical silver, cryptocurrencies in your portfolio, buying the dips as they happen here in the market. So inflation will continue to grossly outpace any gains that people are expecting with regard to earning a higher wage. In real terms, real wages are going to crater moving forward. And what is this really all about, people? What are real negative rates about? Again, that's what we have here in the United States. I just explained that to you. The inflation numbers they're telling us, and we know it's much higher, over 6%. Okay, but a 30-year Treasury has a 1.9 yield, 1.9% yield. You got to be kidding me. In what reality does this happen? Well, in this one, this twisted upside down reality. Anyway, let us move forward here, people. Just a little bit. So there will be no deviation at all from our current strategy. Okay, none, zero. What is our current strategy? We're going to be in this market, people. We are going to own large cap dividend paying stocks. Bet against the debt. Become your own central bank. Buy the dips in the market moving forward as long as the dynamics don't change. Okay, we're going to remain steadfast, and I will keep all of you on top of this every day, like I always do. Okay, what else did I want to cover here? I already explained to you that I do expect to see price manipulation with regard to gold and silver to continue. I expect to see cryptocurrencies be very volatile this year too. Why? Why does Greg Mannarino expect to see cryptocurrencies be volatile? More so. Again, we already understand the space is extremely volatile, but you got all this talk about regulation. Okay, so you're going to see some pretty extreme swings in the price action of cryptocurrencies, but what does that mean? For Greg Mannarino, well, I'd be buying all the dips there too. In my view, cryptocurrencies are massively undervalued. Massively. Bitcoin, the mother of them all. I already explained to you I would not be at all surprised to see Bitcoin reach extreme new highs this year. But again, like I said, I also expect to see extreme volatility. Absolutely. All right, people. Pretty much that's it for today. I don't want this video to be too long. Now listen, beginning every month, I humbly ask for your support. I usually do this on the 1st of every month. Well, I couldn't do it on the 1st because, well, yesterday was Saturday and you did get to see the Crypto Kid. So people, I hope sincerely that you choose to support my work. I work my butt off for all of you, and I know you appreciate it. And I appreciate all of you from my heart. And if you think that my work is worthwhile, that I am a good guy and maybe you should support my work, I really hope you choose to do that. In the description of this video is a link. You can click on that link and support my work. I always suggest, how about just $5? $5. That's all I ask for at the beginning of each month. And I really hope you choose to support my work. I got your back, and I sincerely hope that you got mine. So please support my work. Click on the link in the description of this video, and I would greatly appreciate your support. With that said, people, I will see all of you in the morning. I love all of you. Ponder the things I have spoken about in this video blog, and, well, that's a wrap.